the laptop.
Oh, you need an outlet?
Should.
No.
Oh,
Yeah, I do. Thank you. Sorry.
That's okay, here's the pen.
The rest of my
So
How are you?
Good. How are you?
Good to see you.
All right, now we will call the meeting to order. So, notice of this meeting was given in accordance with the previous provisions of bylaw 0164B of the Riverside Local School Board of Education, which was adopted in accordance with section 1.450 of the ORC and the Ohio Administrative Procedures Act. Can you call roll, please?
Mrs. Krasinski,
Here.
Mrs. Grassi,
Here.
Mr. Audino,
Here.
Ms. Brewster,
Here.
Mr. Byers.
Here.
Can we stand for the Pledge of Allegiance? I pledge
Allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
All right, so that brings us to our work session, a discussion of financial planning and levy options and a presentation on TIFs. I just want to kick off, I know Dr. Tino and Dr. Thompson received a handful of questions, maybe half dozen, maybe a little
We did,
more.
yes.
So I know they've taken some time, they've revisited the plans by taking a look at, again, the facilities plan that we just passed as a Board of Education as a district. And also their plans, ask some more questions. I know there's been a lot of collaboration on this work just to make sure that we are ironing out all the I's or dotting all the I's and crossing all the T's, so
We are
we'll go through that.
absolutely trying as we go through. Before we get to that, I did run this by Mr. McIntyre, wanted to provide a special update on our stadium lighting situation as we have a driveway closed right now. We did have a light pole fall on Sunday. Thank goodness no one was around and the campus was closed. It fell across the road, falling onto two of our brand new vans, but they can be replaced. Basically, at this point, we have a claim filed with insurance. We do have a company coming tomorrow to move the pole off the road with a crane to pick it up and turn it. We have one van that is new that is still functioning. We're going to move that van out of the way first, but there is glass in it, so our bus mechanics we're making sure that all of the intakes and we're vacuuming out all that so we can safely make sure that we move it and then get the other two vans to file those with insurance. Move the pole, get the pole removed. As well as to where we are, we have closed the stadium until further notice. We have an inspector coming tomorrow as well to look at the other three poles to make sure that they are sound and we're not going to have this again. If we do, we have a plan to get those down and then go from there after that. So we are working closely to that and working closely with insurance to where it is. So on Sunday, just to kind of show you where we are. I don't know if this is oh wait, that's the second one. Where's the first one? So we'll show quickly. This is the actual view of the pole falling. I cried at that one. And here's just to show you kind of the view from the field as well. You can see the pole in the upper right. It's swaying. It was windy, but there it goes. It's sheared off from the base. So we look at kind of how it's sheared. They were installed in 2002, so they're not that old. So we do have some questions as to where they are. And that is really kind of where we're at with this. As we work, we do know that we're about 10 weeks out if we were to get new lights and what those look like. They do not make the metal halide lights that are like that anymore. We do have to replace at least one pole with LEDs. So we will have a mismatched pair if we're able to save the other three. If we're not, we will replace them all with LED lighting, and I will update as we move forward.
Will there be any recommendations if we can save the other three lights about anchoring them somehow or preventing?
The way that the anchoring wouldn't have changed anything.
would
It's
not.
sheared off at the well. They're
Okay.
actually the base is still anchored in tightly
Wow.
into it. So if you look, I think there's actually
clean, like it looks
It's
like a
just like a-
surgeon.
If you look right here, it actually shows, like, this looks like it was just
Yeah,
cut
it's
off.
just
There's
perfectly.
a little piece of metal here where it broke off, but it's at the weld that just went
Wow.
all the way through. So we are trying to get our field at least available, because we have all kinds of camps and everything else on it in the community, museum. We've also, obviously the fence is damaged as well, so we have a fence company coming as well to fix that
So you said 2002?
along the way. 2002 they were installed.
Okay, so that's still 24 years.
Yes.
So the
they-
new technology,
They're
what's
supposed to
different?
last about 50 to 70 is what we've been told.
Oh, I see. I just
The new
wondered-
technology, a LED light will be actually significantly less in energy consumption. The light poles will not need to be as tall, so it'll be shorter as well, so that will prevent some of that comes from it. We looked at replacing these at one point 2 years ago with an LED retrofit for it. It was about a $200,000 difference to put the retrofit in. We think it's going to be, we're estimating or somewhere between, 400, around there is 400,000 if we had to do all 4 poles. Obviously, part of that is an insurance coverage. We will try to submit the rest with insurance as well, because if we can get an inspector to say, yes, they're all bad, and it's not if, but when, that's a concern that we
What
have.
was the, I know that, I understand the company that manufactured these is out of business. Did it come with some kind of warranty of some sort?
We are looking for all of that documentation. So when it was put in and when we've had some of that, we are going back and searching the archives, trying to find, that was 3 or 4 maintenance directors ago. I did call Dr. Kalis today. That man's memory is amazing. He told me all about it. So he did have a lot of the details, but again, not the files on it. So looking for the files, he told me kind of where to look for some of the files. So we are looking for some of the files that we're looking as well, so get some documentation on it and what the next steps are.
So one of the vans is really crushed, you can tell, is one salvageable.
We think so. We have to see, when we look at it, if you look at it from that, we do think so. We are concerned about the way that it hit in the corner and whether that's a support beam or not, and what they will fix and what they just say is a total. So that is more of an insurance company decision than ours. The one in the middle is, that's no bueno. So that one's,
Unless we make it a converter.
yeah, I don't even know if we can do that. I mean, it bounced off of it. So, and when you look at the pole, when it hit it, there's a dent in the pole where it hit the van the first time and then it bounced again. So it was, again, glad it was a Sunday. Nobody was on campus. There were no events, all of that. Of the times this could happen, this was probably the best, worst time.
So how did you discover this?
I got a call on Sunday from Mr. Arlesic, who I'm not sure how he got a call, but when I get a call on Sunday from Mr. Arlesic, it is not a good thing. I welcome his text, but when he calls, something happens. So he called me on Sundays, and I just said, "This isn't good." He goes, "No, sir, it's not." And I came up and looked at it, and I think people who saw it, there were a lot of people up to see it. I think they thought it was AI at one point. When I saw the picture. It'll be something to see.
All right. Thank you.
All right. Next up. I have David Seed here to kind of reintroduce some of our new board members to the casement TIF and the agreement for that, and kind of what we have expected down the road, what's coming with the casement property as requested. I will.
Okay.
One short.
Yeah.
Yeah, I have some more.
I do not.
It's just
Dave,
one.
you know?
That's a big one?
Yes.
Yes, plenty. There's plenty. Oh, there's.
He needs the compensation.
Can you just sit here, is that okay?
All right, let me first explain, first of all, say hello, hope everyone's doing well. Thank you for the opportunity to work with all of you. Tax increment financing abatements. There's a couple ways. Abatements mean you don't pay property taxes. So if you have a tax abatement on your home, let's say it's 50%, or at business, they just don't pay taxes on that portion of the property. It reduces the property tax bill. If Steve was in Akron or Cleveland, you build a new home or apartment building, you get a 15-year, 100% tax abatement. No taxes are paid. Tax increment financing is similar but different. It's technically an exemption from real property. But the taxpayer continues to pay full property taxes on the property. I look at it as akin to a diversion. Unlike an abatement where no taxes are paid, with tax increment financing, full taxes are paid. But the taxes, as I will explain, are diverted for two purposes. One, to pay compensation to the Board of Education, and two, for use by the local government, in this case the township, or return back to the developer. Okay? So with every property, it could be an abatement or a TIF, there's what we call the base value, what's currently at a site, the current land, the current dirt. Schools, all taxing entities continue to receive 100% revenue on what's the site that's being developed. So if the school district was receiving $20,000 a year, they'll continue to receive around $20,000 a year, subject to changes in evaluation and millages. It's what's constructed on the site and the value of what's constructed and any change, additional value of the land that's captured as incremental value by tax increment financing. Think of an oil cookie. It's the cream in the middle of the cookie. So if I use this example, if a commercial property has a value of $100,000 base value of land, and something's built on it, it has a value of $900,000, and the total value is $1 million. And let's just say, for sake of argument, the taxes are $20,000 a year. The taxpayer is going to write a check to the county treasurer for $20,000. In my example, 1/10 of the property is the base value, so $2,000 of that $20,000 will be distributed to all the tax entities that you see on your tax bill. So schools will continue to get full revenue on it. It's the other $18,000 that's the incremental value, the taxes on the incremental value, that by legislation of a township, municipality, or village can be diverted to the city or village, in this case the township, for use to pay, one, the school compensation, or to township can keep it or return it to the developer. So it's a great tool for economic development. Think of your own house. If you could put an addition on your house and it added $100,000 of value to your house, and you paid an extra $2,000 a year to Lake County on your house, and Lake County could send that $2,000 to Key Bank to help pay for the amount you borrowed for your addition to your house, wouldn't that be great? You could largely pay for your addition to your house by diverting property taxes for use for, in this case, your development, in the case of economic development. So we come to a project like Casement, and this project required, when it was presented to the board and the township a couple of years ago, and that's why I turned over the page here. It's a 5-phase, 1,358 unit housing development. And you'll see from 2 years ago, the average sale prices for the 1,300. This is what was known 2 years ago, what they would sell for. And they're going to be built in phases. What I understand is phase 1 started. I'm talking to the developer, Laredo, a few days ago. Phase 1 has started. Why it's in phases is that the developer is using the proceeds from one phase as they sell homes to pay for the construction and development of later phases. And the market can absorb 1,358 homes at one time. We'll go through this in a second. Okay, so you want to put up 1,358 homes on a large piece of land, that's about 200 acres of land. There's an incredible amount of public infrastructure costs. You have to bring water, sewer, all sorts of utilities to the property. That's why the township came to the schools 2 years ago, asking for assistance. Essentially, the bargain they're asking for is, would the schools give up a portion of their revenue? In this case, you're going to be held harmless. That's how I'll explain it. But would you temporarily give up some of your revenue in the short term to gain significant revenue in the long term? I'm working on the Cleveland Brown Stadium right now, and that project, that school district is going to have to give up a lot of revenue for the long term to get a large short term, get a large long-term gain. A lot of projects, schools are not held harmless, but there's a potential, still a potential large gain of revenue that they would not receive in the absence of the project. So every school district that's faced with a TIF would ideally like to have what's called a school-friendly TIF, where the schools are held harmless. The schools receive full compensation. That's not always possible. Now, townships have various authorities with tax increment financing that they can do. One is they can impose on you a 10-year 75% TIF, where you would only receive 25% of the revenue for 10 years. They can do that without a vote of the school board. So going into this negotiation, we were aware that if we completely balked, they could just go ahead with 10 years, 75%, leaving you 25% for 10 years. That outcome would not be advantageous to the developer, because the developer is looking to take advantage of a 30-year tax increment financing, which is the maximum time period allowed, and to have 100% of the property exempt from taxation. All of the taxes diverted, except the revenue that goes to you and the Career Center. They're compromising the taxes that are distributed to the county portion of the township to other smaller tax increases. Whether it's right or wrong, this is what goes on throughout the state of Ohio, okay? The county's bread and butter is the sales tax. So while they're losing out on property taxes, they primarily rely on the sales tax. So, and I think this flow chart I'm going to go through it to explain it. So, remember, we have multiple phases, and the 30-year clock will start as each phase is essentially being completed. So you'll see in the materials we're providing, some of the phases don't start for another 10 years. Okay? But in general, what this sheet is showing you the flow chart of revenue. Under the TIF that was negotiated 2 years ago, during the first 10 years, the school board receives 50% of what you normally would receive. Then in the next 10 years, you receive 75% of what you normally would receive. And in the final 10 years of the 30-year period, you receive 100% of what you normally would receive. Now what we negotiated, because that was largely unacceptable, was that the project was going, and a concern of, I think, 3 of you here and other administrators, was that the project was going to generate excess TIF revenue. And we wanted to negotiate terms that as soon as it generated excess TIF revenue, that the amount, that any revenue that we had foregone, there was extra money available, it could be paid to the school district as soon as possible and called catch-up payments. So essentially by, I'm not sure, I think it's like 2038, all that any revenue the school district did not receive on account of the TIF will be fully paid back to the school district. That I'll explain in another spreadsheet. I'm sure in a second. But essentially, we're taking a short-term loss of potential revenue, and with catch-up payments, we'll be made whole. This is as opposed to other TIFs where schools are never made whole. They agree to give up a portion of revenue to gain a portion of revenue. So what's going to happen here? Okay, so property tax gross TIF revenues. Remember I explained to you the $18,000? This is everything but everything but the taxes paid on the land. So the county is going to collect the gross tax TIF revenue on the incremental value with the appreciation of the land and the buildings, the part of the tax bill that's from new construction and appreciation. They're also creating what's called, I don't really want to go into further, to generate new revenue. The developer created what's called the New Community Authority. It allows in this project site for the levy of 4 additional mills that's being used to generate funds for permanent improvements to help develop the site. The taxpayers of this property are voluntarily agreeing to buy a home to pay 4 additional mills of property taxes to essentially help to pay for all of the improvements at the site. You buy a home, you voluntarily are committing to pay 4 more mills than someone else, and that money goes to the project. What they're looking to do is with each phase is with the projected property taxes based on the overall millage and this NCA charge, is go to a bank and borrow against that, just as a school district would borrow, again, using future proceeds. To borrow against those future flow of revenue, we get money today for the public improvements. So you'll see what's called one is the debt service. That's the first obligation. We'll go through this in the spreadsheets in a moment. And that was a set amount that was agreed to, the maximum. And then second would be the school board payment. You'll see right, it says use of funds after debt service. First is the school board compensation. That's the 50% for the first 10 years, 75% for the next 10 years, and then 100% for the final 10 years. And then, you'll see in number 1, 2, and 3, you'll see I detailed for you the breakdown by the 3 trimesters. And then the township is also going to receive additional revenue that they negotiated. And then we have excess revenue. And that excess revenue will start to accumulate after a few years. And what the parties agreed to is that if there's, and that gets to what we call accumulated TIF revenue. Once, what the developer anticipates is, think of water flowing from one cup to another, to another, to another, to 5 cups. Is the developer wants to have $1 million of excess revenue. But once they have more than $1 million of excess revenue in the fund, that excess revenue can be distributed 50-50 between the township and the school board. That's how we're being made whole sooner rather than later. The initial proposals that we received from the township was that we would get paid off in 2058 or something like that, or well out years 28, 29, or 30. And that was unacceptable to the school board for us to be paid, to wait to be paid off 30 years from now. Does anyone have any questions up to this point? So I wanted to go through this. I'm going to go through the compensation agreement in a second. I want to go through this table here. It's in the compensation agreement. It's the last spreadsheet. But I wanted to provide to you in color. It's easier to understand. In this compensation agreement, we attached the spreadsheets for all 5 phases. Right? They're summarized on this one document here. These are estimates, but it's a summation of all the phases. Okay, so we have years 1 to 46 because of the different phases. That's the left column. Tax year, collection year. Remember, taxes are collected 1 year after they're levied. And then we have collection years, so you see 2026. and obviously nothing's being collected this year and likely next year for 2027. Because these were, there might be, depending on what's done this year, there could be a little money coming in 2027 collection. The data, remember, for money to be collected for 2027 and 2028, that means you're measuring the improvements that existed as of January 1 of 2027. You build a home today, this summer, it's not going to be on the 26 tax bill paid in 27, it's going to be on the 27 tax bill paid in 28 because it was constructed after January 1 of 26. There's always a lag. Because you're measuring as of the date of value of January 1 of the tax year, and then you collect the next year. So the estimate was that, see the column marked SE full compensation. This is what we should be getting every year if we were fully compensated. No tip. There was no tax increment financing, and the developer went ahead with the project. We would be receiving the amount in SD full compensation. Just give me a second to look at that column and look at the bottom. $180 million over the 46 years. This is based on the millage rates and the projected sale values of these homes, exceeding the nominal base value. This is additional revenue in addition to the nominal revenue you're going to get on the land, spread across all of these 1,300 homes. So you could see if we were no tip, if they went ahead with it, it starts at $335,000 and ends up going up to $7 million by year 2057. Now, why does it drop off after 2057? It's because some of the tips will be staggered in over 5 phases. So as properties fall off and no longer subject to the tip, they become taxable. You will receive the revenue in the normal tax collection process. So keep that in mind, that it's not that you're losing revenue, but that you are just receiving it outside of the tip. Okay, so when your treasurer in 2055, we'll talk about that.
I should still be.
Okay. And I know that, so think, because the property, once it hits year 30, it goes off the exempt list and becomes taxable, so it's not in this calculation. Okay, so the problem is they can't hold you harmless, okay? They couldn't do that. Remember, we're doing 1 to 10, 50%, 75, 100. So, under the terms of the compensation agreement, in year 1, you're going to get $161,750 in 2028. And that creates, you see the second column to the right, that creates a shortfall. And the accumulated running shortfall is $173,378. Everyone with me there? So I go to the next year. You should have gotten $521,648. We're only getting $269,872. We're short $251,777. Add that to the deficit. Okay? And then you go to the collection year 2030. We should have got $697. We only get $360. We're up to $761,000 in the negative. 2030. I'm not going to go for each of these, but we get to 2035. We should have received $2,150,000. Well, let me start out with 2031. What's going on there? In 2031, we should receive 976. We only receive 505. But there's a surplus. Remember I mentioned that once there's over $1 million of excess revenue, the township and the school share that 50-50. So if you add $31,515 to the 505, and then take that, that's and then offset by the 976,907 we should have received, we're still down $439,000. Add that to the deficit. And the next year, we should have gotten 1,402. We only get 889,000, but look, that catch-up payment is getting bigger. So the deficit that year is only $79,000 to be added to the running deficit. And on, and you can see by year, you can see that by year 2037, or 2036, we're eating away at that deficit, and by year 2039, it's completely gone. And it essentially at that point becomes a school-friendly TIF, where we're held harmless. The village will be paying us what we should normally receive. They can't pay us more under Ohio law for this type of we tried, but they saw the section of the law that said we're going to pay you up to your loss of revenue. So the column with the catch-up payments is essentially the fifth column from the left is a mechanism that provides for additional revenue to make up for the loss of revenue from you not being held harmless in the early years. Now,
David, can I ask a quick question?
go ahead.
During this time period before the TIF expires, 30 years, the district passes a new property tax. How does that impact us?
Good question, Steve. We negotiated the agreement that we get 100% of your revenue from a property tax side.
Dave, I,
Yeah, only property tax, sure.
so Dr. Thompson has done a fantastic job about sharing, informing us about House Bill 920 and its impact on the collective of property taxes outside of inside millage. Because the tax is tipped and is technically abated, these taxes until 30 years do not reduce anyone else's taxes. But after 30 years, other property taxes will go down because of the overall burden in House Bill 920.
Okay, good, very good question. Technically, all this additional value, hundreds of millions of dollars, is exempt property. It's the same as this building we're in right now. So it's not treated as taxable value for school funding purposes, at least right now. We don't report to Columbus as taxable value. It's not on that reporting. And it's not part of your property tax base for the calculation of your 20. Technically, additions to property are not, the 920 does not impact new construction. It's the changes in the value once you add the new construction to the duplicate. So if you add a $1 million house in Riverside, in Painesville Township, that $1 million does not impact the 920 calculation. It's the $1 million value going to $1.1 million, $1.3 million. That's what impacts the 920. So one of the benefits of TIFs is that this added value is not, you add this value, it doesn't mean that your millage rate goes down. But that's a key benefit.
So, let me ask you about 2055. I'll also probably be dead. I'm gonna ask anyway. At that time, that's when the first phase starts to come off this roll and goes on to the regular property tax rolls, which is why these numbers start to decrease in year 29, 30, whatever. And then that money's not going away because we're still going to get it because it's increment financing. It's not current value
Right.
financing. So you're going to continue to be collecting $7 million regardless of whether or not it's here or it's over on the other
That's
side.
we're going out so far to project.
Right,
But
I get it, but it's estimated.
I think that's
Plus
a good-
inflation.
If they move $1 million, let's say a year comes up and you were getting $500,000 from this, and they move it over to the taxable property, you're gonna get the $500,000.
It's not like it's going
tax.
away.
No.
I mean, it's still gonna hit our revenue streams at that same dollar amount. So eventually, by the time we're at year 46, 47, we're still collecting $7+ million every single year, just in a different line.
Correct.
Question 2 is with the potential constitutional amendment to eliminate property taxes. In technicality, these properties are exempt from property taxes. And go. What happens?
We're
Do
not
we
gonna
know?
get- We don't get revenue from these properties because there'd be no property taxes. Remember, the taxpayers continue to pay property taxes
Okay.
on the properties. The homeowner here, the 1,358 homeowners, are not, unless they're really curious, okay, unless they're really curious, their tax bill is not going to indicate there's a TIF. They go on the auditor's website, it may indicate that. But if there's no property taxes, then there's no tax bill to pay. So
So what happens to
The developer
the
goes
developer?
into default,
Yeah, and the developer, and that's, okay. Like,
basically.
yeah.
Just like we do if we don't collect property
I
taxes
mean,
from
you've
the
heard,
owner.
you've heard, in a testimony,
Yes.
all the bonds, everything is tied. The safest source of revenue for government funding is property taxes. So that's why it's easier to borrow against property taxes than sale, think of the Great Recession, when unemployment went up. It's hard to borrow against incomes. It's harder.
So that's why, I guess that was part of my line of questioning, is that if we go with property tax for any future or current or future facility improvements, the chances of the state allowing districts and people who have debt that's being borrowed against property taxes and allowing them to go into default is slim. I'm not gonna say it wouldn't happen, but it's gonna be slim, because they're not gonna let every school, college, university, hospital, everything that is being funded by bond financing to go into default. That would be in a perfect world,
You're talking about an Armageddon
I
situation.
get, well, I'm just saying, like that, to me, that's like a slim chance.
That's why the efforts have been undertaken with the legislation in Columbus, and why many states have considered abolition and have never done it, and that's why you saw last week, the General Assembly is increasing the homestead exemption, which a lot of people have discussed. The biggest issue with property taxes is with seniors and those on fixed incomes. Addressing that issue is one of the largest. The issue is always, how can the General Assembly pay for those things?
Well, and I guess my piggyback to that is, and I'm jumping ahead a little bit maybe, but if you are paying off construction with property taxes that are outside of a bond levy, you're putting yourself at risk.
I'm not an expert at this, but it's in terms of the document that if you're signing that document and your security is the property taxes, then what, recourse, you're taking that into account.
It's different than a bond issue, that's all I'm saying.
And I think we'll get more
Yeah.
into
Yeah.
that with,
So, right, you can
Yeah.
continue. I just wanted to make sure we're gonna continue to collect this $7 million.
I mean, what we negotiated was, in the event you do pass a property tax levy, because their modeling doesn't assume additional millage. So if you pass one, it likely over the next 46 years, so that, but again, if we didn't ask for it, the township, see, if we didn't put that in the agreement, let's say you pass a 3 mil levy, and there's 3 more mil, we would get paid off sooner. The township, if we didn't ask for it, they would have just kept the 3 additional mils, if we didn't ask for it.
David, how does the rollback impact this? Or the piggyback of not only the owner occupied, but then also the homestead? If obviously these homes are going to be majority they're owner occupied, so there's that doubling right there of the rollback.
If there's less collected, it impacts you the same way it impacts you now with less collected. It's, see, remember the
Because
chart here?
these are predicted based on the values of the homes?
Projected based
Okay.
on the value times the effective millage.
Okay.
So when the county has the two, that was it the piggyback and the homestead, have they decided that yet this year?
They're telling us that at least for one more year, they're gonna maintain both exemptions.
But that it just means less revenue coming in, which means,
These projections would all be overinflated, for example, if those stayed in place in perpetuity and it was senior housing, then these numbers would all have to be reduced.
Assuming the average sale price.
and if the sale prices are higher, it means
Then-
more revenue.
Right.
It means that means the catch-up payments will be larger. That means you'll be paid off soon.
Okay.
If the values are lower, it means they'll be pushed off into the future.
And then I have one more question, and we are assuming that there's houses being built in '26 that'll be on the register for January 1st of '27. That's not gonna like I haven't seen anything.
And when they're moving dirt.
They're
Yeah,
moving
right,
dirt.
they're moving dirt.
That's all
I
right.
would
So
expect,
it's
I would
probably-
expect 20.
So probably everything in this schedule just moves down a year, right?
We have no control over that, so,
Yeah,
okay,
right.
that's,
And I don't know if anyone recalls at what stage did they talk about the access from the development to Madison Avenue? Like there was gonna be a road,
How many phases were there?
I can't remember
Five, I
what
think it was
phase.
stayed in stage 4.
I'm
It was in
thinking
one of
it
the later
was
stages, 3
mid
or
to,
4.
yeah, okay.
But that doesn't affect our revenue.
No.
No.
No, I'm just wanted that to be on the table, that there was a plan for that.
I mean,
We do have to
I
buy
mean,
that
that's,
land.
I think one of
We
the
have to buy the land?
purposes,
So it's gonna cost us.
It will cost us more.
one thought is when you look, when your administration, you look at you have some guidance here as to when you should start receiving revenue, and it's
Right.
really more or less pushed off for, it's not within the immediate 3 to 5 year period.
And it's prediction, right? So like you said,
Correct.
how many homes, what's the value of the homes? So,
And it's
And
not
you said-
reflected in any forecast. Zero is reflected in.
right, today we do not have it reflected.
Yeah, no, and these prices, they were saying, these are now 2-3 years old, you said? These
2 years old.
2 years old, so they potentially could be higher.
They were significantly lower in the first meetings.
You have no, and again, like, and think of it this way, another thing, while they're making you whole likely within 10 to 15 years, okay, remember, anyone could propose any development and have an article in the paper, and you just, treasurer can't count on it until, and
If money comes in,
and, and the developer can, at any point here, the developer can cease pursuing this or sell off part of it. We know there's a huge demand, but we don't have control.
So I think the story here is there is potential for additional revenue, right, at some point in the future. Hoping sooner rather than later. It's in our best interest as a district if they start to build on this and putting up the homes, right? But again, we just cannot.
I would look
Count
at it
on-
like think of it like an industrial park that's, what's gonna come on a large industrial campus, that over time, there'll be added revenue, but it's gonna take a period of time that you do not have full control over, but it's a positive as opposed to, you're in an increasingly blighted area where things are just turning south. But it's in your immediate 3 to 5 year forecast, it's not a huge impact. I hope that helps explain it. The agreement is here. Let me just touch on one in response to a question. Page 7 is page 7 of this agreement is the school payments. Number B2 is additional school district millage payment. And it says for any exemption year, for each phase of the project, the annual payment to Riverside and Auburn comprising the payment for additional school millage. And the definition of additional school millage is means it's 100% of the taxes due to any new millage approved by Riverside and Auburn after the date of this agreement.
Did we determine who's tracking all this?
I believe in here that there's a administrator trustee that has to be engaged to do that. In any event, I'll be here for the next 46 years.
We haven't determined that yet, is that correct?
I thought it was put into the agreement that we were gonna have somebody who tracked it because,
Well,
Yeah,
we did,
there has to
but
be
I
There
just,
would be, it's in the agreement, but also the fact of the matter is that all of these, all these 1,358 homes, the county's gonna have to code them so that the taxes paid on all of these, beyond the taxes on the base value, remember, the village, the township is gonna be very interested that the county sends them the right amount of money. The township is getting money from this project. More importantly, debt service has to be paid. So the township and the developer for the debt service want to make sure that they're receiving full revenue. Not only just because of you all, the school board, but it's the township's getting money from the project and the taxes, the so-called service payments are being used to pay off the debt service. There's huge motivation to make sure this is calculated properly. So I would anticipate that they would have and we discussed it, that they would have an administrator, a trustee, that would oversee this, they would engage someone.
and will they be engaging them? Will we be doing that jointly?
They would
Because we had the issue with the other tip that we had, that it wasn't, that nobody.
Dave.
Okay, great.
Angel.
And we wanted to make sure that that didn't happen, so I know we built it into here and we wrote that in here. I just want to know who's responsible for naming that individual firm, company, who's going to do that, and how much oversight do we get over there? Thank you. If I'm still here, I'll have questions. I know, right?
Even if she's not here.
You know, I might show up at a meeting just because.
We
Looks
have
like
here,
some
in
Eight.
sections 3 and 4 address these questions.
Right.
Sections 3 address how the township and the schools will work together to communicate with each other as to all the information for the tax rates and the collections. Reconciliation, section 4, page 9.
Okay.
The township and school districts shall annually meet to review, calculate, and reconcile payments to the school districts on or before December 1 of each year. The township and school district may engage a consultant for assistance in the calculation, for which the township and school board may request reimbursement for service payments prior to the section I'm referring to, and any unreimbursed expenses. So what we would have to do at a later time is work with the township as to who is engaged and how that person is compensated.
But not until, again, the property starts to, okay.
It would be, right now, if we were paying someone, it would be a very easy job.
Right. I could do it.
But typically, I have one of the flats in Cleveland, the flats east, downtown. Huntington Bank has a third-party administrator, you know, they're out there, people, and Mike knows of his groups and others that prepare these reports and oversee that.
You'll still be here 2057 too?
I'm hoping to be here by the end of the meeting. That's not an insult to the meeting. That's
Yes,
more
it
comment. That's more comment on my well-being. That's it's been a long day.
So I know for Jimmy Lee and Joseph, do you have any questions of this from you two?
So far, so good. Thank you.
This is kind of my profession, so.
What?
This is kind of my profession, so it should make sense to me.
We didn't screw up too much?
No, I think it looks really good.
Okay, any other questions?
Who's doing the update on Painesville City?
so next up in Painesville City is,
Thank you.
Thank you.
yeah, thank you.
Thank
is,
you, David.
We do have Mike Priscilla, and I did not know that Austin McGuan of the Riverside McGuans will be here, are here to kind of present an update of Yes, that's correct. You'll love Austin just as much.
Set a high bar for me.
Yeah. So he is here to provide an update on the Heisley Park TIF update, as well as potential costs associated with a income tax levy.
It's good evening, good to see everyone. If you can hear me from here, I'll just remain in this seat. David did a lot of the heavy lifting in his presentation exactly on how these TIFs work. That particular TIF has the benefit of projections, whereas the Heisley Park TIFs, we have the burden of historical performance that needs to be addressed. So I have been working diligently with the City of Painesville, their council, trying to dissect the information that was put forth in these original TIFs. So right now we're focusing on two specific areas, the Shamrock TIF and the Encore TIF. One of which seems to have a very convoluted payout structure. I was briefly talking to David about it before the meeting started, where you would think the way it is structured, because it is within the realms of that 10-year 75-25. However, there was a secondary portion of that TIF compensation agreement that specifically targeted the catch-up payments, as David aptly describes them, at 100%, but over specific multiple zoned areas. And it's extremely complicated and very convoluted. And that's the one TIF. Now, the Encore TIF, we don't believe there have been any payments made yet, though per the compensation agreement, we have reached the status of payments should be being made. The duplicate has met the standard that's set forth in the compensation agreement. So these are the arrears payments that we're currently trying to calculate with Painesville's council. Ultimately, what I do suggest, inasmuch that the district has obviously very capable counsel relative to the TIF side, and that I represent both the city and the schools, which has been laid out in our engagement agreements, that I have discussed this with the city, that what we need to do is readdress the compensation agreements originally drafted on those two TIFs and streamline them. They are going to require kind of a restructure. And before that happens, though, we will go through, and we are already in the midst. I have two accrual reports in front of me as to what has been paid to the district and what should have been, or what possibly may have been overpaid to the district. Because of this complex underlying zoning complications with the original TIF, the problem is that since the TIF was instated, there is nothing that we're finding that kind of held the rezoning of these properties in check. And coming back to that very particular comment about an independent auditor overseeing these TIFs, these particular TIFs sorely needed that. That is not anyone's blame on either side of the situation. Unfortunately, these TIFs, when not well represented, seem to fall through the cracks when there's not good oversight on the documents. Which brings me to the last point on these TIFs. The documentation for these TIFs themselves are sparse. And we're working off second, third generation scanned PDFs. So we're having difficulty even reading some of these compensation agreements, let alone figuring out their underlying structures. So the main rub lies with the zoning on some of these particular parcels. But I have a parcel inventory in hand. I have been in contact with Lake County Auditor, specifically Barb Hoyja, who's been incredibly helpful with kind of outlining the parcel inventory for us. So I got council working on this. I think ultimately what I would like to do, and I'll talk to David further upon conclusion of our discussions tonight, that I would like to engage him on behalf of the city to kind of meet in the middle with, or on behalf of the school district, to meet with in the middle with the city, renegotiate these structures, come to an agreement what is owed, and realign these TIFs so they're much more straightforward in their interpretation, and then apply an annual audit to them, much in the same vein as was just discussed for the casement TIFs.
How old are these?
They started And I'm sorry, a lot of this just broke for me over the last 24 to 48 hours. So that's why I don't have any prepared material, because nothing's really has been established. So I don't want to disseminate any material till we know it is proper. Give me 1 second. So I am showing the first payment started in 2019. And we are showing on the one for Shamrock, but I think they were, yeah. So we are showing no payment in 23 and 25 for one of the TIFs.
When did those originate?
So they hit the duplicate, I believe they started in 2018, hit the duplicate in 2019, per the compensation agreement, that's when the first payments were made.
Mr. Purcell, thank you for all that, and Mr. C, thank you. When you say that the city isn't meeting the agreement, what gives them the autonomy? Is it just simply because the documents are not legible?
The city has unfortunately experienced a kind of a bump in the road with the turnover in some of their administration, and they had a terrible situation with the conversion of software that was systemic throughout their entire administration, where a lot of information was not compiled electronically as was promised per the vendor of that software. They have since severed that agreement, but as you can imagine here, what it takes to reconnect accounts with your depository banks and with your local chapters, it was a mess. So I think through the conversion process and through the lack of continued oversight there, this is something where unfortunately the auditor can only take it so far as to say, have you made this payment yet? The auditor is simply a bookkeeper at that juncture. So I'm not making excuses for them by any means, but none of this was done with any intent.
I appreciate that. And that you're saying this is what's new to you in the last couple of days.
We have been working on this for over a year. And the documentation, lack thereof, was our biggest hurdle. Then, unfortunately, it seems like I said, making no excuses, but I got a large list of them here. We had one lawyer who really, on behalf of the city, was doing the lion's share of all the work, very unexpectedly resigned and went to another firm. They were hoping that there could have been some reciprocity there to have shared the work that was done, but I don't know what happened there, nor can I comment, but somehow a lot of work was lost.
Last question for you, and not to put the cart before the horse, but even though this is still relatively new, how complicated do you think this will be for them to untangle?
It's not going to be that complicated as long as we have, again, capable minds to come together, realize the complexities, and simply iron them out. I think there has to be a realization. We are not talking about, I think, what the schools has received versus what the TIF should have paid off. We're pretty close. I don't think we're talking about large sums of money that are in the ether here, nor are we talking that something that is irreparable, because it definitely is reparable. So I just think we have to come to a much more efficient approach to the compensation agreement, outlining the properties, making a much more understandable, overarching approach to the zoning of those said parcels, which that's really what's getting complicated, because certain parcels have been rezoned where they're no longer under the TIF agreement, but now they fall under what there is a JED out there as well.
You're able to calculate what the county sent to the city of Painesville
Yes,
for every year.
yes.
And then once that's known, like the spreadsheet we showed you, the other one, what was paid each year to Riverside, what the shortfall is,
Right.
or if there was an excess, and then discuss how that shortfall should be handled.
Yep.
And remember that if there's a shortfall and it can't be paid back immediately at one time, where your portion is only part of the total tax bill, I don't know what the rest of it's being pledged for. I mean, the rest of it, the non-school property taxes are being pledged for, but there may be money accumulating to the city beyond what's paid to the school district that could be available to reimburse you for foregone revenue. But we would just need to know what's been sent to the city, what's been sent to you, take the next steps, right?
That's it. And I think we have gotten a good amount of that information preliminarily accrued. But the problem again being is it being accrued properly according to the underlying parcels. That's where we're kind of at a stalemate with the county, yes.
So the original agreement, obviously it wasn't structured like the casement one. Was it a typical one?
It
that
was
you're only
very
getting a
convoluted.
small
Yeah.
amount, like
The-
25, I don't know. I mean,
We're
some of them
dealing-
are 40, 50.
And the majority of what we're talking about on one of these TIFs has nothing to do with owner-occupied homes, which makes it all the more
Oh,
complicated.
okay.
So that's the thing, when you're doing mostly retail property, owner-occupied property, you have a much more delineated approach as to the calculations. You have a base value, and then based upon the assessment by the auditor, you have your incremental value starting to increase. Here, each one of those scales has increased or decreased independently of one another. And so that's where we have to simply say, some of this is the way it's written, and I am not a lawyer, but the way some of this is written, I mean, it is almost indecipherable as to how you could possibly calculate exact amounts of money. There is so much, I guess, I don't know, some of the language is so intense, it becomes nebulous. It's like, that makes no sense. So we've got the lawyers combing it over on behalf of the city, therefore, because that is obviously going to be on their dime. So that's why they know their commitment, they know that they have to reach an agreement, they have been more than willing to get through this. We just talked, we're working with the city currently for a note related to their EPA grant. So this has been an exercise in efficiency for us, having just recently done this transaction. This has all been going on in the background. We've got a lot of progress made. So we are very close to coming to this agreement that David was kind enough to just summarize right there. Get through what's paid, what's owed, what may not be owed, streamline the underlying properties, and we're well on our way to do that. I'll be reaching out to all the necessary individuals here in the next few weeks to start getting us on the phone to get this across the goal line.
So I guess just to recap, possible revenue out there,
Yes, oh yes.
unknown what it looks like. We hope that we can get some clarity on it
Yes.
and have updates soon.
Yes.
Right?
The district has received revenue from this. So there has been income from this TIF already taken in by the school district, sent from the city. We just need to get it up to snuff.
Yep. Perfect.
It sounds like there's some level of negligence on the part of the city. And then that leads me to question, why don't we, if it's an indecipherable document, would a judge throw the whole TIF out and it's just taxable?
If that is the approach you wanted to take to this, we would then have to kind of take an examination of what had been paid and making certain that whatever exit clauses are in there. But that is obviously something the district may very well want to consider. I do think this one, though, having provided tangible revenue, it is your best interest to negotiate kind of either catch-ups or streamlining it to make certain this revenue continues per the compensation agreement.
I'm not aware of, we did not negotiate these agreements. But you have a copy of these agreements, or?
I have individual pages. Honestly, the documents have been very difficult to come by.
Doesn't have a copy.
And this,
I've not been asked, and I
Well, we should have a copy.
We should
of
have
those.
a copy.
Well,
Isn't it?
I mean, they would be very, well, money. I know we
Melinda's gonna
were.
check her email.
Because even
I
this-
am gonna search it.
We signed it.
Gary would have been.
Yeah, well.
is
Well,
it
this would have been at the
what
beginning of high
kind,
school.
maybe
That's
you
like
want to address,
2007.
what was the term of the TIF? Was it a school-friendly TIF, or was it a?
There's definitely, there are make-whole payments on behalf of the school district. They did not, this was not a TIF, it was approved by the school district. And there are minimum service payments that have been made. As a matter of fact, the one TIF that has just met their threshold beyond the service payments, that's the one we really want to pay attention to, because for the last 2 years, that has produced a surplus, and there is money due to the district on those 2 years.
Well, Okay, so between the school district and the city, we can obtain any
I think it's
documents.
a timeline.
It would also be filed with the Ohio Department of Taxation. It would be included in an application down there, so Mike and I can talk about how to get the documents, anything missing. Interpreting it, if they've made payments already, then they should be, it should be easy to interpret.
Again, the big problem was, in the midst of the TIF, there has been a significant rezoning of one of the areas. So it really has kind of turned the TIF on its head.
Do you think that it was a situation that the district was not paid because they had a few different finance directors there?
I definitely think this is something, again, there was no intentional neglect, there was an oversight, but yeah, through the course of changing specific administrators, now they've definitely hit solid ground. They are very willing, they want to get this resolved as badly as you do. I have gotten no resistance from them whatsoever. Just prior to Dr. Thompson coming on board, we were already making some progress with Mr. Platt.
So I guess what I would ask, Mr. Steve, if you don't mind working with, and then maybe we can get an update on what possible direction. Again, we want to maintain a good relationship with the city also, so I think that's
Mike,
important.
was the rezoning the one piece of property that was zoned to conservation?
I believe that was part of it, and then they didn't build on any of it, where there still, though, was designated under the TIF agreement.
This is the east side of Shamrock? on the open field?
Was this the, I know Gary
I'm
was
not
monitoring
super
some
specific on the parcels, I
taxing
apologize.
situation. Remember, he was
We
watching
will,
something.
I will
Was
work
this
with
it?
Mike,
Part of
and
it falls into the same thing.
See,
we will
Gary
follow
was-
up with
Gary
Chris and
was-
Steve. We'll then follow up with you. Is that okay?
It's interesting to me that the auditor's office of the county doesn't keep this documentation and calculate these things as it's under their purview of tax payments, like you would think.
There are two, under the law, in one situation where the TIF is school friendly, where the legislation provides for the school board to be held harmless, the legislation can direct the county to pay the school district and its normal payment, so the county makes the payment. This county does not like to do that, and I've talked to the auditor about it. They prefer that all the funds, all the service payments, remember the incremental value I spoke about, the taxes on the incremental value be sent to the local government to then distribute to the schools pursuant to a compensation agreement.
But they're still distributing the tax, and they still have to collect the tax, and they still have to assess the tax. You would think that they would have a vested interest to do it appropriately and track it, so that's just a disappointment.
They're simply directed by the legislation to send all the property taxes on the incremental value to in this case, the city of Banksville.
Well, one question I would have is how, if you have an agreement, how can something be rezoned where it doesn't allow our agreement to go forward? I mean, isn't that a litigated issue?
I don't know so much if it was rezoned so it couldn't go forward, but it was rezoned in a manner, though, that I don't think it got caught on the auditor's side of things, where then the original TIF had applied to a particular type of zoning, the auditor just didn't catch up. That is the issue. It wasn't so much that the zoning was in conflict with the agreement, is that the zoning created a glitch in those very collections.
I can't imagine the zoning would impact the operation. Where it would impact it is the amount of revenue that's generated, right? So if you had, let's say we just talked about casement, right? The developer plans casement, they come in front of you, you approve it, right? And then a year later, the township changes the zoning for the site, right? Creates a larger minimum lot size. They double the minimum lot size. Instead of it now being 1,300 homes, it's now 600 homes. Well, that would just flow right into the anticipated revenue that you're going to receive. It wouldn't bar the payment to the district. I've not seen this compensation agreement.
Okay.
So we have to review it to see what it says.
Yeah.
Would the same be true if they went in the opposite direction and rezoned it to commercial?
Fighting something.
If it made it more, if it made a more valuable use, it would increase the revenue potentially, yes.
Wasn't getting
It was initially light commercial, light industrial, I believe, and then they shifted the owner and shifted the compensation, and we did.
The TIF is not likely to go to what it's zoned, it's simply about where the money goes.
Right.
So, again, it sounds like we have a lot
There
of
were a lot of
unknowns.
complexities to
Yeah.
all of this had a lot of, there was a lot of parties into it.
But we are, I want to read it, we are not starting from square one here. We've got a lot of data, a lot of input, a lot of analysis. Now we just have to come to an agreement, make certain we're accruing these payments properly, find out what is owed, what is not, and then we're just going to redraft. And then there will be new signatures on the new compensation agreement. And the city is ready to negotiate those new terms.
Let the city know we're happy to set up direct deposits.
I'll go pay well.
Not that far.
Right?
All right, so if you're not confused enough, we'll move on. And actually, going to skip ahead to talk about just some information that we received back as we did the resolution of necessity from the state taxing authority. We did receive back a formal letter that said the $13.8 million annually would be equitable to a 1.0% earned income tax. So they do round. It was actually a little bit more than that, but they rounded it back to 1, which would roughly equate to a 7.89 mil property tax levy. One thing that Mr. McIntyre and I have discussed going through this is the ballot language. If we were to proceed with the resolution of this, to proceed, thank you, would be the recommended, we're allowed to specify one of three things. We can specify that the 1% is for,
This is in the resolution.
In the resolution.
Not the ballot.
okay. So in the thank you. So in the resolution, we can specify that it is for, you know what, and go.
I'll turn it over to David.
In the resolution, it can specify that the purposes, this is for property tax levies too, for current expenses or for permanent improvements. Now, there's a provision in the law that allows in the resolution to specify for it the purpose of the levy is for current expenses and permanent improvements. The district in the resolution would need to specify a portion, how much of the 1% will be portioned to current expenses and how much will be a portion to permanent improvements. At your next meeting, should you elect to vote to adopt and send the levy to the Board of Elections, in that resolution, there'll be an apportionment spelled out for you to consider of what percentage, I guess, what portion of the 1% will go to current expenses and what percentage will go to permanent improvements. Now that's slightly different from the ballot language. Ballot language in Ohio is prescribed by Ohio law and cannot be deviated from. It's in 5748.03. And in that ballot language, did you have that up, or I can go through that?
Is that in perpetuity?
It was a good question, Belinda. The term can be for a number of years or for a continuing period of time. In Ohio, we have property tax levies. The maximum amount, I believe, is 10 years for the general property tax levy. It could be longer for some other levies that no one dares to put on the ballot because they never will get passed. But for emergency levies, before they eliminated them, it was 10 years, and for current expense levies, it was 5 years for property tax. But we have a choice for a number of years or a continuing period of time, noting that at some point in the future, you can always, the board can cease a levy.
I don't know if that was my question is the apportionment going to be in perpetuity? Or could
Yes.
the board in the future elect to say, I don't want to do that anymore?
I think that is the question that we are getting to, because there is language, but we don't know what it means because it kind of contradicts itself.
Yeah, David could talk more about this, but there's language that, and I'm not sure if this is answering your question, but there's language in the statute for school district income tax that allows the apportionment to vary by year.
That's murky.
But if we do an 80-20 split, which 20 is not enough to pay the debt issuance, right? So it is not enough for debt service. But we want the flexibility at the beginning when we haven't pulled a COPS yet, and we're staggering the COPS to COPS issuances, and the purpose is so that we can dig ourselves out of the financial hole that we're in. Plus, it's not until 29 that the income tax will hit full collections. But if we do, correct me if I'm wrong, David, Dan, if we go 80-20, we know that we can take general fund and transfer it to the PI at any point. In other words, to extend it from 20% to 25% or 30% or whatever that number is that we need to pay that debt issuance. What we have to make sure, and what we've calculated is the dollar amount from a 1% going to be enough to secure us financially for the foreseeable future, at least 7 or 8 years minimally. I think longer than that, but I'll be conservative. And during that same time period, make our debt payment.
So I'm gonna ask the question again, because I'm gonna ask it differently. If you say, for example, we're gonna apportion it 80-20, 70-30, however you decide to apportion the revenue, is it a requirement that the 30% for permanent improvement go into a separate fund in perpetuity, and it's not gonna change? And if you're gonna say we're not gonna do that, then you can change it, and another board can decide that we're in fiscal dilemma right now, we need to pay teachers. Like, I wanna be real.
You would default on your loan.
I understand that, but I wanna be real clear about like what that proposal, what is
It
it?
would be, just as in a property tax levy where you do a joint current expense and permanent improvement property tax levy. It's
Would it
ongoing.
have to go in, like,
It's
would that,
into- you'd have- unless you were to come back and replace it essentially, terminate it, the 20 years from now, terminate it and replace it with some new type of, new terms.
so if
But
we
this-
said, if
let me-
we said it's 70-30 and 30% would have to go to a designated fund, and you then would not be able to spend that on current expenses. Just like a property tax.
Yes.
Just wanna make sure I'm clear.
Unless you terminated the entire,
Oh, right, but, okay.
Can I ask a question on that? What would be the harm in doing it all for current expenses?
That's a good question,
That
Mike, and
provides the most flexibility, except
I don't like the language.
the
on
language,
ballot.
what's the political issue is, you're saying all that's going for current expenses, and as opposed to some of it going to permanent improvements.
Because you would read on the ballot and it would say nothing about building facilities or anything else. So wait a minute, I thought I heard Dr. Rattino or Mr. Patrizzi say this is gonna be a building based out of this, but the language doesn't speak to it. So that would be incredibly confusing at the ballot box.
Can we, before our board meeting, get some possible examples of the different types of language that would look like in the different scenarios? I'd be curious to see what those look like.
Specifically to that question, scenarios of the 80-20 split.
Well, to a
And
split,
or
yes, an
70-30
apportionment,
split.
or to no split, like, but you're still gonna do it. I wanna know what those look like, because the public will not,
And
The
also
resolution, the resolution
personally-
will specify the apportionment. The ballot language, because it's prescribed in Ohio law, will simply indicate the purpose for the purpose of current expenses and permanent improvements. There's no provision in the law to spell out the apportionment on the ballot.
But you're doing that by resolution.
Correct.
That another future board can't go and change.
Correct.
Okay, I just want to be clear.
Why could that not be changed?
I don't know. That's what
The
I'm asking.
resolution to proceed?
No, I thought Ms. Krause was saying that if we were to go in with generic ballot language as suggested by Mr. C, in terms of there's no specificity aligned to the apportionment as it is stated on the ballot, it is going to be an earned income tax that is going to be applied toward capital and operating. The board then proceeds with a resolution to apply an apportionment to say 80-20. Belinda, you are of the belief that once that change is made, that it cannot be changed
I
again?
don't,
That's what
I
she's
don't,
asking.
that's
Yeah.
what I'm asking, because
I
it's,
don't see why, but again, I'm
Right.
definitely not a lawyer, but I wouldn't see why.
The ballot, the ballot language is fixed, so.
right, the
it's not-
ballot language, I don't have a
The
problem.
resolution, you would want to, it's gonna be specified at the apportionment, okay? You're going into a completely gray area as to whether you can change it at a later date. The argument against that would be that the board that put the issue on the ballot said it was gonna be 20% for permanent improvements, 80% for current expenses. So how can that really be, you're going to a whole gray area, and in the tax levy, you never want to go into a gray area where someone would come in and challenge it, right? Challenge the collection on the levy. The thought pattern I think your treasurer is getting at is the same thing with a combo property tax, current expense PI levy, is that you're indicating what you anticipate going out into the future. You definitely want to set aside for permanent improvements, okay, for a PI fund.
So,
But
With-
because it's not going into a designated PI fund by law, like it's not going to be, it's not designated for that, because it
will
doesn't have to be
it won't-
sent, it doesn't have to be spent on that. Once it goes into a, like you pass a property tax levy and you pass it for PI, it goes into a PI fund, you can't spend it on current expenses. This is your choice, but we're designating it up front. But who's to say another board, 10 years from now, 8 years from now, 5 years from now, decides they don't want to do that anymore and they would like to designate it to be 90-10.
I think you are committing that if you're saying that 20% of it is going into the PI fund, that's where it will go.
Yeah. Yeah, the statute's clear that you can vary the apportionment by year, and the resolution to proceed has to contain the apportionment language. However, the respective portions of the PI and the current expenses, as I said, change by year, but they can't ever exceed the original amount. So if you say 1% income tax, and it's 80 for current expenses and 20 for permanent improvements, then you are obligated, at least according to current Ohio authority, to make sure that 20% of that money goes into a permanent improvement fund.
But you just said it can change every year.
Unless you say in your resolution to proceed that you're gonna do year one 80-20, year two 70-30, year three 60-40. Or any variation.
Year 3 and all subsequent years, you would land on 64.
Then, if you do that in your resolution to proceed, then you're obligated to put those monies as apportioned into the correct funds.
And then when that is paid by the state, because now it's not being paid by the auditor because an income tax is paid by the state, are they going to pay it into the permanent improvement fund? You know, like when we get property tax money, they separate it and they give it to you and you get it in two funds. They send you two documents, two payments. Sometimes it's two payments, but they send you two documents.
I think this is going to be, I don't know, this is conjecture, and we will certainly try to assist whatever we can research it. I was under the impression, though, that money comes in to general fund with a transfer to permanent improvements. So,
Which transfers are approved by the board, so again, like
but you're gonna be bound to that.
But even our $15 million COPS that we just took out, a board 5 years from now could say, we're not gonna appropriate the money to pay that.
I
that loan
understand
back."
that, I absolutely agree, like
So it's really no different.
no,
And
that's
even in that regard,
just way bigger.
the creditors
Well,
know
yeah, more money.
that there is an underlying permanent improvement that funds that, but the board is not legally bound based on the resolution, to pay it from permanent improvement. It's why we generally refer to COPS issues a lot in our industry as a general fund borrowing.
Or pay it at all.
Well, you could walk away from it, that's a whole other.
Yeah, let's not go there, I
Yeah.
know that we're not going there,
That's
I'm
a,
just saying.
and that's just a terrible
Just-
So
consequence.
I do think that although we are struggling with this, I do know that we are not the only district, even in Lake County, who is considering a levy like this with the split. And on November, so it's not only, it won't solely be us that has to sell this. Now, we are, of that I know, are the ones who are putting a new building project, and I see
But
definitely
that's,
building
right,
project.
we're a little bit different because of
But
that.
there are other districts who are considering an income tax, an earned income tax, and specifying a percentage to operating and a percentage to permanent improvements.
There are also some specific times when somebody does a bond levy for facility building that they have to put on operating dollars to
Correct.
be able to play. That's a
Yes.
requirement by law also, I get that. I'm just trying to wade through all the scenarios,
No.
folks, I need to understand.
I think
And
what,
I
I
just
think
wanna
what the
clar-
treasurer is mentioning is, when you discuss the split, because you're setting forth a certain amount for PI initially versus current expenses, you're calculating, because current expenses can be used for PI, you're trying to anticipate, but PI can't be used for current expenses. You're trying to create deficits.
But I would also agree that ballot language that ballot language, now I know that we don't necessarily, but ballot language that contains the actual intent of it for both current expenses and permanent improvements is beneficial because it does explain the purpose of it. It's not just
That's
for
what I want.
current expenses. And I think that
Ballot language.
declaring some sort of split is essential to this. I think the 80-20 split as it grows makes sense. Maybe 70-30 as we look at, but 80-20 is definitely the safest as it goes. I think we have enough to go with it, and how we explain this is a very difficult concept as to what this explanation is. But it does really benefit from some of the things that we've talked about a lot that do hamstring us. It's not subject to House Bill 920. We are projecting growth in it, and we are projecting very conservative growth. We are projecting growth. I think with the discussion of the TIF and the houses and all of those developments that come, yes, we are going to see, we talked about and discussed the future revenue from that, but as they move in, assuming that they are working to afford those houses and not necessarily retired, and if they are, then they're not impacted, but if they are working families with students, we will, as soon as they move in, give it, I would assume the next school year, but we would collect income from them immediately and not based on the infrastructure of the TIF and TIF agreement and all of that. It's an immediate raise in income from right there, where our concern with the TIF, and yes, we worked hard to make it school friendly, but still, if we have a number of families move in, even though they're building ranch houses first, we all know people can, I grew up in a ranch home and families can live in ranches.
I love a ranch house.
Yeah.
I hate school.
We've all discussed that as well. But really, in looking at what that is, we don't see that revenue, but we see the impact with children and all that. This gives us a way to address that both from an operations standpoint and a facility standpoint. I think that is one of the ways in terms of where we look at potential additional revenue and growth and kind of how property tax is there. It's also not bound to all of the scrutiny that comes with property tax right now and all of it that's there. I know that it's, and I agree, and I think we all agree, it is not as safe as a property tax issue. I think we've all come to say that, but I think it is still to where this district is and the growth of it and what we are seeing more houses come in, we are seeing more developments come in. I think those developments are getting tiffed and jetted, if that's even a verb, but
No,
let's
that's-
use it as a verb. And all of those others, I think we're seeing those things happen where we don't see the impact, the full impact, until 10 years down the road. But we're gonna see this, the students come from it, and we're gonna need the property if we were to be successful with this. And I think that there's a very good shot. If we are successful with it, that gives us an opportunity to capitalize on the residents as they rent now and not impact our seniors as much. And it's not although the levy, the hard part for us, and we're really working to sell it, is although the levy language speaks to continuous, it's not continuous for the individual, because the continuousness ends when you retire and start collecting your pension. Or if you change employment, or and your salary is less, it goes less with you. Whereas a property tax issue, either continuous or for a 37-year period of time, that's the rest of my lifetime, as far as I would say. And that over that time is much more of an investment than it would be for and we're a 2-income family, and it's more upfront, but it's a shorter period of time that we're paying more upfront, and there is some of that. So having people have that, that's a tough calculation. It's a whole lot easier sometimes to say mills is so much for every $100,000, and that's also tough because you got to add up all of that. But 1%, the math on 1% is easy. I know how much it's going to cost me. This is how much it's going to cost. But then this is how much it's going to cost you. How long do you think you're going to work? This is how much it's going to cost you. Roughly, versus a 35-year on what your house is and reappraisals and all that. We are expecting to see that reappraisals, but then you can put in. But the state's doing property taxes are that's advanced calculus and then some.
One of the things I wanted to bring up was, and you probably have read some of this, Concord is planning a town center project. I'm sure you've been part of those discussions. And one of the things they mentioned, which was a surprise to me, is another school in that complex.
They've not mentioned another school to me.
I read the whole
complex
plan.
at all. I did, and I know that plan, when they kind of came together with all of that, was really what would you like?
Concord Center.
But I don't.
I think part of that plan was already,
Part of that plan was
it's
there.
older.
They repurposed some of it.
repurposed some
Well,
of it
they
because
know
that
they're
was-
gonna need another smaller fire station because of the density that they're going to create in here. And who they're trying to attract, yes, seniors, kind of what we heard with Casement, but then there'll be affordable housing starting at 300,000. This is what everybody always says, for families and to be able to afford. So I'm just saying, population-wise, we could see a lot of students in that portion of
could.
Concord.
And I think if we saw that population, again, this is where that income tax would come in right away, which would be a benefit of immediate revenue.
But again, it's
But
not
that's
even.
down the road, and I think, I've talked to, and part of it, and talked to some Concord, is the true infrastructure that's there, and having the infrastructure to have the high-density housing that they need, and all of the things they need to have that infrastructure put in place. That's a long ways out, including, sewers. Casement's biggest struggle right now is getting the sewers to Casement from Erie Shores. And we're running it, and Erie Shores still has issues with sewers and the sewers backing up. And to make sure that that doesn't happen in a 1,300 home development like Casement, which are already on the grid and ready for on the grid. Concord to develop, we can still go to that same station. Or they'd have to develop a new treatment station, which is, that's an incredible amount of infrastructure money that they have to put up. I don't think they have that, and that was it was a great group to be a part of, to sit and to talk about the visioning of and what they think and how they want to change the development and all of that. And then the company that came in kind of said, hey, this is the plan, this is how we see Concord Township changing a little bit. I still think that a lot of the residents who are there come out and say to the part of Concord is, we appreciate the green space, we like the bigger lots. Yes, affordable homes to an extent, and affordable at $300,000 is a starter home. I mean, if you're buying a $300,000 starter home, you're probably at $400,000 by the time you get a home with actual doors and closets and everything that you need into it when it's a new build. As anyone who's been a part of that starting point is always significantly lower than where you get into. But I do think, they did talk, there were developers who sat at the table who said, if you want local developers, you need to look at density, because that's how local developers will take a project, is to work on higher density housing. I think that's a solution that's down the road. I'm not even sure that they're gonna approve that. That's still under some of that where they're
They
still.
did another rollout the
Yeah.
other day, and it sounds like it's ready to go. So I would appreciate if you'd follow up with Andy or whoever.
Yeah, I mean, again, that casement was coming quicker than it is, and it's still
I know, we just
trucking
need
along.
to
So I
know
think
timelines.
you're correct, but, I think,
I just had one question. I think from a meeting prior, maybe finance committee meeting, PI fund can only it's capped, is that correct?
And what?
Can only go up so high for a portion of general fund or something like that? No.
No, it can only be used for certain things.
Yeah, okay. So I was just wondering if that was the case, and so my memory is not as good as it once was, so that there's no issue if we start collecting too much PI fund. That's all I'm like kind
We
of.
have,
That
we
may have
have,
been about the debt
no,
as part of the percentage of general fund that you can have on the books. from a
Say
percentage.
that again?
The amount of debt you can have as a district.
That's 9%.
of
You
your
can, although your debt can only be 9% of your total property valuation.
I think with this as well, when you look at some of, if we do have to, and as we look at how we portion it and all of that, yes, we talked about two distinct phases, two distinct borrowings, and we can kind of bring the, bring the Encina guys, and we talk about that a little bit more as what that structure looks like. But truly, while we are looking at the construction part of the new wing, which is phase one, we know there are projects that are of substantial amounts of money that we need to do along the way, and that will bring down the total cost of construction in the end. So if we start while we're doing the phasing of the new building and design and all that, if we looked at, okay, the roof project here, or the boilers, or things like that that we could do over the summer, and working and utilizing those summers as well, before we get into the guts of revamping the whole, the high school, those big mechanical projects, which can be done in schools over time and off times in school, will be beneficial not only to the overall cost of the project, but then also in the funding mechanism that we're using, because we will say, and we can put, this is what we're doing, this is your tax dollars at work, kind of here's where we're moving towards it, here's our vision, we're getting our vision ready, and as long as we are working all towards that plan of the master plan of the document, we know that we would do that. So those are things that we can definitely address sooner rather than later, which we may have to do that. I don't think anyone sat here thought we would have opened the meeting with a conversation about a light pole that fell. But we did. And that's a newer item that's there. So looking at kind of where we are, having money in a permanent improvement fund will never not go unused. And I think that's something to say. But yet making sure we have enough to capture our operating expenses and pull us out of the hole that we are going into by choosing this funding mechanism with deficit spending is also, it's not that we're gonna get this and be flush with cash. We have still counted on being lean and continuing to be lean and to operate fiscally responsible. This is the one that answers all of it.
Okay, so as far as the current permanent improvement levy, we're generating just shy of what, 3 million a year?
About 2.7.
2.7. All right, and then when the bonds sold, they came in favorably, so the amount of money that's coming out for debt,
Just a little over $1 million, like $1,020,000, I think it is.
Yep, remember.
1,000,000 too.
Yeah.
So
No,
that,
not a million.
No, 100
$1,020,000.
oh, 20,000.
Not
Million
200,000.
Okay, so say 1 million, so that leaves
Yeah.
1.7 million or so for other things as it stands right now.
Yeah.
I just
And-
want to
and-
have that figure in my head.
And there's no question it's tightens things up, for sure when those debt payments for that 15 million begin. But that, I feel a lot less stressed about that PI fund if we're renovating this high school and building a new addition. I feel a lot less comfortable about our PI funds if we're still patching this building together for the next 10 years. I'll tell you that much. That scares me.
I just want to give a chance, I know you had some other things that you wanted to bring.
So I was asked about the ELP program and what that is. So just to provide everyone kind of where that is, that's part of the OFCC program and the schools facilities program. It stands for Expedited Local Partnership Program. We built our 2 new elementary schools as a part of that ELP program. It allows school districts that are not yet eligible for state funding under the CFAP, or the Classroom Facility Assistance Program, to move forward on a plan. We can construct a specific discrete portion of the master plan using local resources, which are the 2 elementary schools. So we had to have a plan approved. We did that. We do have to build to the design level standards. And once we become eligible, the money is applied as a credit towards the local share of any further programming. They just changed some of that language specifically to say it is now a credit towards what is allowable in the design manual, and that is it. So it will be less than the total cost. So if we built a total cost that was a $100 million project, I'm just using easy math because it's getting late. So if it was a $100 million project and we were eligible for 15%, we would say, hey, we would get $15 million. However, if of that we had some local initiatives or things that weren't built into a design project, we'd have to take those out. And so we may only be getting $10 million because, say, now I made the math hard again, but say it was only $90 million was actually part of the plan. So part of those come out of what's in the design manual, and they have tightened that up. They also, as part of this, put a accelerated aging facilities plan, and I was really excited about that. So I was like, oh, let me look at this one.
It's 100
Well,
years.
it's 100 years. So we are, in 24 years, we can apply for that.
Gee.
But that is one where they would fund 40% of a renovation project for a district. So we're not, so again, we sit in perpetuity. The other part of where we're at in the ELP program is your name has to come up on a list. We were 10 years out 10 years ago, and we're still about 10 years out now. So we are and it's the 5-year average. Right now we're 518 out of 609 districts. So the number of districts has shrunk, which is always a good. So we're getting closer on that end. In fiscal year 26, we were actually 509 based on the CUP report. So that estimates an 86% local share in any OFCC project. When you're looking at high school projects and the design manual and an ELP project, you're looking at it to get to the design manual plus the locally funded initiatives that our community wants. You're looking at a 15 to 20% raise over what a project initiative would come through. So is at some point in building a high school, the question is the juice worth the squeeze? And sometimes, and in high schools especially, as you look at auditoriums don't count. They build cafetoriums. Second gymnasiums they don't build. Which we would need a second.
And they only build small gymnasiums as well.
And it's small, and so those local funds that you raise become a little bit more challenging to what you can. And again, if they're not going to rebate us for any of those other things, yes, they'll give us money back, but is the money that we are spending into it more than what comes back?
The other piece is the LFCC, based on their own evaluation of the facility, would not. They wouldn't fund a renovation of the building.
So it would be interesting though, like how much does, OSBA, OASBO, school districts in general advocate to our legislators who are out there to ask them to change the laws regarding payback and asking them, hey, you owe me $4 million on a project I did in 2017. How about you ante up because you're giving away all this money and you've got all this excess revenue in your rainy day fund now because you're collecting extra revenue. And it annoys me because we don't do that. Nobody advocates for these things and we got money sitting out there. We have money sitting out there from our last project.
We do.
And nobody says, hey legislator, why don't you propose some bill? Well,
Too busy writing the success sequence.
Well, here we go. But I think the other part in really looking at kind of the capital bill, and we had some conversations that's part of a partnership tour about how we can get into this capital bill for some other opportunities. So we've talked about what that looks like and what those people like, and that's a partnership program that's not a part of rebuilding this. But when we do this project, can we bring other partners involved? And we had a really productive meeting with Lake Erie College to talk about what that looks like. And who else do we bring to the table? So Lake Erie College needs space. They're landlocked. We've got space, let's talk. And let's have some of those conversations. And we started a great productive, we'll have some follow-up. And we will bring more people to the table to really start to look at the next capital bill. Do we put a significant ask on for a one-time for a project that is really outside the box? And we're spinning around some great ideas, and I think that continuous spirit of us combined with Lake Erie, combined with Auburn, and even bringing in some other local townships to all come together for something that the whole community wants, that's the goal
Yeah,
of some of these. But that's for a later date.
I think going back to what Belinda was saying, like, I get your frustration, like, right, like, we decided to invest in our district. We got our community to invest in our district. There is a guarantee of funds back. I can't help that these other schools aren't doing that, so give us our money back, right? Like, I get it.
I would almost argue we were forced
We
to.
agree,
Right,
yeah.
like, we
And
did
I
what-
think we were forced to, and I think we're at the same point now where we're forced to again.
Like, we did everything that they said, we followed the rules, we did it all, like, we jumped through all the silly hoops and whatever, and you know what, like,
The ELP program in general is starting to lose its novelty and popularity because of the very circumstance about which you're speaking. Promises made, and then it's simply kicking the can down the road.
they had money.
So again, I think it's something as a district, I don't know that
It's
fits
not
this
part of this,
discussion,
it's
but-
just,
but I agree with you, like, is there more that we even as a
That we can
district
do.
can do, or,
So-
you know, what, and not just you, I'm not saying the superintendent and treasurer only, you, the board members too.
all you
so.
need is a few legislators to propose a piece of legislation, it's not that complicated.
So, but-
So I think getting them to listen to us at all is always a good thing. And I think we've had some of those conversations as we continue on, and getting to the table with the whole people are something we've really made an effort to, and will continue to do. So looking at where we are with timelines, because timeline was a question, November 26th, the issue passes. In January 27th, we start to assess the tax. Fiscal year 27, we would see approximately an estimated 800,000. Again, whatever that split would be, that would be split amongst the two funds. In 28, we're looking at 9.6 million, again, split. That's starting to dig us out of our deficit spending. And then in 29, it fully collects, and we're thinking about 14.5, and that's adjusting with some of that inflation and all of that. I think that's where we would see it. Again, they would split. Again, if we went with the 80-20, or that would not, 20% of 14 million would not cover the note on the COPS. It would be two borrowings, but we would have to put more from a general fund. But it would be definitely one that would secure to say we are invested in this project.
What is the percentage?
It's about 40% by the time.
I think it needs to be a 60-40 split.
60/40.
Once we're at full collection. And I would put it 60-40 right now, except because of the slowness and the buildup of the collection, we can't do it. Otherwise, I'd lock it in at 60-40 and feel comfortable with it. But it's those first 3 years first 2
But
years.
you're not gonna, are you gonna have a debt?
Well, it depends on when we
Like,
pull.
you're not gonna have a debt payment until after you sell, and you're not gonna sell until closer to.
True, but if we pass in November and then we start engaging our architects, the fees begin.
You also-
Not huge fees initially,
You would also bank it.
yes.
Just because it's in there doesn't mean it has to
But
be spent.
we'll invest it all, just like we're doing with the 15 million. Mike did a great job. Mike set up a Star Ohio account for us, and we'll earn as much interest as we can. It's not subject to arbitrage. So we're gonna make money off our $15 million issuance. We'll do the same with the additional COPS.
I would be inclined to have us do the allocation as close as we need to have it.
Would it make sense to do, since it's only on the resolution and not on the ballot language, which makes it a little easier, would it make sense to have a resolution that spells out year 1, year 2, and year 3?
I think for me anyway, I would wanna see like, how does that pan out with your payment structures? I want it to match, I want us to be whole when it comes time to doing bond payments.
My concern with that, and this is a legitimate concern, is yes, it's 60-40 as of today, but that COPS payment is going to stay steady, so that 40%
true.
is going to be less of the 40 by the time we're done as it grows. So, because of the COPS payment's a consistent,
Well, and so is an income tax, pretty much.
well, the income tax is gonna
Well,
grow
no, it's
2% a year. So, or 1%, 1 to 2, or even more. But
We've layered in moderate, aggressive,
Can you go
and
to
very
that slide and
conservative.
just show?
Yep.
This is what he's
I
talking
mean,
about.
well, then over time, if it's, 60, 545, whatever it is.
I agree, I get what you're saying, I agree with you. One of my concerns, and I asked Dan about it one time, was how do we make sure that another board doesn't come in after we promise the community something?
Correct.
So I'm glad, I don't know that you and I were talking that same language, so I'm glad we're having more discussion. And I asked Dan about that a while back. I think they found a solution, and now you're saying, let's just get it as close as possible to just make that even more solid. Like,
I want-
So if
Right.
we're looking at a minimum, like, so on average, so it's a $6 million payment, it does raise a little bit here, but I think if we look to structure this, so we're looking at, I guess that's back to the gurus of syllables, can we structure this so that it fits, so we can do like a 60-40 where we're paying the cops, and as the cops rises, and that payment rises, so it rises with our projected.
Or if it just comes out to be less, I don't care if it's 70-30, if I'm gonna collect and do 30% now and bank it, I'm gonna eat
Well-
some of that up later. I just wanna make sure that we are not selling ourselves short and doing
Yeah,
something.
I get it, the other thing, at least that's weighing on my mind is, if we're gonna err, I'm gonna err on not enough money in the PI account. Why? Because we can always transfer. Versus erring on putting too much money in the PI account, and PI's building, and we can't pay our
What
teachers.
about a
But then I-
scenario in 5 years, there's a refinance opportunity and it reduces our debt service drastically, then we just got a bunch of money in PI.
Yeah. So I guess a question I have, Dan, and you may not be able to answer this off the top of your head, I understand exactly what Belinda's saying. Could a board pass a resolution that would say for X number of years, 40%, 35%, whatever number makes sense, that's what goes into the PI. As a resolution, would that be binding to the board as they receive those dollars?
So separate from. the
Separate from this
resolution,
transaction.
Yeah.
Just a separate resolution? Board
I
Board
think
action.
the answer is yes, but I'd like to confirm that.
Or
just to
even
make
policy, create
But then-
policy.
But then I also
Sure.
have,
That's interesting.
I have an issue with, I can't see those years, sorry.
Chair.
Which one? The last two.
2058 and 59?
Yeah.
Yeah,
Is this
thanks.
how-
Again, I
Can we
will
see
be,
this?
yeah, I will be dead. However, in those years, then I have I like philosophically have an issue with the fact that we are now collecting money that I don't need for a facility.
In 2058 and 59, Riverview and Parkside will be 40 years old.
Oh, but they're built differently and they're
So
only 40.
they'll be neat.
Oh, don't say that, what's happening in Asheville County.
You want me to
So don't-
But I'm just saying,
Well,
right?
Yeah, well, and that's the other part. I mean, so having money, we have still building projects.
I get it, but
that are
again, when
there.
I go back and I say this is why I believe that splitting the issues is, I'm only collecting what I need for that facility for the years that I need it, and then when it's done, that portion is done. And it's done, it's gone, it's over, and I'm just collecting the income tax.
We'll create a Rossi scholarship.
I'll be dead. Like, I won't
I
know.
I think to set a term of 30 years, a 30-year expiration, I mean, that's, I don't know whether we're gonna get the,
Well, again, I'm not saying, I don't want to, I would not want to have an income tax for operations expire, but
Again, I think there's opportunity to go back, our attorneys have told us that there is an opportunity if something changes. You know, the state of Ohio begins to fund public schools.
30 years from now, everything's gonna change.
We start
But if-
collecting back from the ELP program.
if you decide to, you don't have the opportunity to change the original turn. You're gonna collect 1% income tax. So you can't say, well, now I really only need 0.75 because the building's done, so now I only need, no, you're gonna have to pass a new one at a point, right?
I think Mr. Seeds has something to contribute. I'm sorry, I just want to make sure everybody hears what.
Dan and I did research. There may not be any income tax levy that's been apportioned in Ohio. Okay, it's right in a gray area. The law is, we're talking about 2 sentences in the revised code. It says if the tax is to be levied for current expenses and permanent improvements, the resolution shall portion the annual rate of the tax. That seems clear, okay? We can apportion in the initial resolution. Then it says, the apportionment may be the same or different for each year the tax is levied, but the respective portions of the rate actually levied each year for current expenses and for permanent improvements shall be limited by the apportionment. Which
So I
is
gotta
not-
say,
So
when
in
you,
other words, if you're tied up with a certain payment for the improvements, you have to kind of meet that. You can't
Well,
short
that,
it.
isn't that saying,
Is that what he
if,
said?
if, hearing it for like the fourth time now, isn't that saying you can set it at, just for sake of example, you can set it at 80-20, or you could change it year by year, but whatever you do, you have to apportion it and abide by that apportionment. That's what it's saying.
Yeah,
For that
it
year.
doesn't
Yes, for
So
that.
I'm-
year.
obligate you to meet your, but it
So
doesn't
you,
make you meet your
I
obligation.
just wanna make sure, go ahead and finish what you were saying.
no, I think that's what it's
I
saying.
understand what you're saying.
So if you say it's 70-30 or 80-20,
Yeah.
it's 80-20. I can't go higher than 20. I know
No,
I
you can go higher than 20, because you can always transfer money into the PI.
We
Well,
would,
but you
we would want to
Don't have to.
talk about this a little bit, because it's a new area, but that may be, that's what it may indicate, that each year you could change it potentially. However, this, the spirit would be that you would try to have a percentage that you're not changing it. Because someone might come back and look at what the board initially passed and say, well, you intended it to be for,
Sure.
80% for, let's just say for 80% for PI, and then you come back after the levy is approved and move it to 85% for current expenses, and someone might say, well, that's not what we
Sure.
voted on.
Yeah, that's true.
It's tricky and balance.
It is true.
You always want to respect the intentions
Mhm.
that you all set out.
Well, that's why I feel like we don't want to reduce the 20 to 15, but the 20 to 30 seems fun. Because
You can always add more.
you can always add more, but you don't want to take away from the PI, because that's
So
what they
we're
agree
going
on.
to, what the treasurer's mentioning is, if you're picking a number for the PI that's lower, you can always move money from current expenses to the PI. The idea being that you're creating an amount for the PI, that, like you just said with the issue that came up this past week, there's always PI issues. You're never gonna run out of money, but you can't move it from PI to current expenses.
And then in 30 years, whatever year that was,
Yeah, in 2050, we will have
an excess of revenue in
an
the
excess of revenue in PI, which we will have, I'm sure,
Well,
in that
somebody will
time.
have to figure out.
There will
what to
still
do.
be projects to do, there will be buses to purchase.
Well, that's also assuming that along the way,
Nothing else happened.
nothing else happens and our expenses don't escalate at a speed in which we are not currently predicting, et cetera, et cetera, et cetera. A lot can
A property
change.
tax is unabolished, whatever.
So many unknowns.
Yeah, there's a lot of variables.
We
And
are,
there's still
we're
a
getting,
chunk of land in Concord.
well, and we're guessing 30 years down the road, that's,
got
those are all,
two.
those are all factors that are all part of it. I think this is one that we are being conservative, and we are definitely we are addressing these numbers, the two highest needs on our surveys and all of that.
Let's go to
that come
timelines.
about. So, into the timelines of the project, to really look, so November 26th, we are successful in the ballot. In January 27th, we start to assess the taxes. Again, we don't fully collect until fiscal year 29. As a part of this, that gives us some time, this is a little bit different of a project than a true bond issue, where we are still working and developing with our MOUs and getting our partnerships together as we start to have this. There's a lot of excitement to it, but there's a lot of what ifs as well. And so really, in having those discussions and what this looks like, it gives us time to also look for alternate funding sources to try to get some partnerships here on the capital project budget, to try to make sure that we work with others to utilize what we have to get a part of theirs. The other ones that are there that aren't, that we've talked about a lot, and the questions have come up, is a bus garage. We're having conversations as to where we're going in terms of shared services and all that. That garage that's out there, what does it look like and what does it do? the other part that's needed, obviously, we've talked about the ELP money. If that ELP money were ever to be delivered, that would go directly to funding the bus garage portion of it. The additional turf field, that estimate right now is about $1.2 million to put that in. That's part of the conversations that we are having with our partners in the area to talk about what that could look like, who could use it. Obviously, we allow our community groups to use it, but we have other organizations that have a need for this and have some revenue, could be a revenue source as well behind it, so what that can look like. The maintenance facility, we know we need one. We don't have the answer for that and the cost to that at this point, but that is something that we know is not something we want to ignore by any means at all, and it's something that as we continue, in 2059 we'll have plenty of money for it, but I think we're going to need it before then. So really looking at what that looks like and how that purpose is and where we are, I think that we still continue to have those explorations. That even includes leveraging some of the facilities we have. And as you said, there's a master plan out there. We have a building that's sitting in Concord that has a pretty high value to it. So that could probably be a portion of something that we're doing and having this discussion. I know they do. That's all that. One of the questions came about repurposing Melridge. So Buckeye is complete. We have Melridge. This is to repurpose Melridge into a school for students, for special needs, kind of a magnet school for that. That's not a lot of an investment up front from our standpoint, really and truly. We have people who come there, but in terms of what that is, the electrical in Melridge is upgraded, and on that first floor, we would have success just to put HVAC in. We've had really great success putting these mini splits in. They are feasible, they are economical, they can run on the electric, and we can run through that and have that work for those individual rooms along the way from that first floor. And as the program builds, we will continue to build it. Melridge still has the great gym, which does have an air conditioning facility. It also has the library as well, which is air conditioned. From a kitchen standpoint, a school like that is very small, so we wouldn't need a kitchen. We would probably do a food service at Buckeye and shovel it over. Which would be a satellite type kitchen, so it would just be warming all in, and that would be very sufficient for that. And then central administrative office space, we have money built into this project to address central office, whether it's building onto the house that's over there, or whether it's revisioning and actually remodeling a little bit the current media center into the central office. And that is, full disclosure, that's my preferred, because that takes the John R. space, the actual John R. cafeteria, and turns that into a professional development center, and a large space for large group meetings, professional development, and everything else that is separate from everything else. It still keeps us rather close to the district, to the high school, but yet we are not in the middle of it. We're at our own end. Those spaces are new enough, and it's a pretty doable conversion. So we are looking at the project. What's that?
We forgot the Lamuth parking.
We did forget Lamuth parking. I did forget that.
And then I forgot one in my list.
So Lamuth, I think we estimated over $1 million for the new parking lot to do all of that. But that's our last.
Yeah, there was that probably should go on that list. And then the last thing, like I was just thinking, we were talking about Lamuth. I'm looking at Lamuth, and there was a cost to get that facility where it needed to be, to repurpose it as an elementary building, and there was a pretty big cost to that when we did the phase one.
The move in the facilities plan is, in the current facilities plan that's approved, is a 5-6 building. So it does.
Okay, so
it does shift it. It's not the elementary as much, so there's still a cost to put a chiller in to make sure that it's their windows, roof. There will be some costs to that.
And I think from a facilities committee perspective, we need to get some costs around this so that we know what it looks like. I mean, we're gonna do all these, if the plan is to do all of what is proposed, how is all that going to fit in there? What would the timelines be for these things, and how would that fit in? Or would we just be saying, don't know, some year? We can't do that, because these things, I think, need to get done.
But I think we can, because we don't know when money's gonna come in from the TIFs, or if it is, right? But that could be additional money that then we could
Right.
pick the project, so to your point, what's the price, right? So we could pick the project that we could complete then, right? Or,
So I think that's to the.
But I don't know if
point
we
of-
definitely really just wanna say, well, we'll just put off a bus garage until perhaps that there's funding, or a maintenance facility. Our maintenance facility is,
So.
we have some
in-
needs.
In both cases, I'm not disagreeing to either one of those. I think the bus garage and the issue with the bus garage is solved in the revisioning of the high school and the drawings of the high school, because the real, now obviously there is a facility of the bus garage concerned
don't
with the
have a
lift and the
lift, I
bus
mean-
wash and all of that. Yes, but the other problem with the bus garage is the physical location and the buses and the student traffic and all of that in the morning kind of being coincided together. That can be solved in this part of it because of the way you put in the drives and all that, going around the school, utilizing the front of the school for drop-off, separating that at the high school. I think that does solve part of that issue. The other part of that issue, and the longer-term part of that issue is, what do we do for a bus garage, and is it fitting on the campus, and do we start looking at other places? And I think we start looking at out-of-the-box facilities. Is there a large warehouse that we can get our buses inside and all that? And we start to have those conversations and look at those and what those look like as well down the road as a part of all of this. I know we can't count on the TIF money. We just said that we can't count on all that. But when we start to put some of these plans together, the immediate need and the immediate feedback from the community and everything is you have to address the high school. That is what we hear all the time. Yes, we have all these other things. As that TIF money comes in, and that development is going to happen to some level, and I don't know if we're going to get to all of it, but if we ever did, as that TIF money comes in, that's not calculated in the 5-year forecast, it's not calculated out. That does help offset part of that. It doesn't offset it all, and then we can look at putting part of it there. We also have the alt money that's coming, and all of those that are a part of it.
Yeah. When I look at this list, we discussed wants versus needs. There's things that are wants that are things that are needs, and then there are things that are pressing needs. And I think what I'm hearing you say is, and I think we all agree, the high school is a pressing need. In my opinion, these 5 items and the addition of Melbridge's parking lot is a need, but maybe we put a future date on some of these and not include it in the initial project of the high school and junior high.
You know, in my view, based on 1% income tax, again, I don't disagree that these additional projects are valid and real and needed, but we can't go above 120 million.
Well, and I guess that's
And
my
so,
question, is that if we are not including these things in estimates of what we're gonna have to pay for in the future, and 1%, because we can't go higher than that, isn't gonna be enough, whereas I'm just concerned, where are you gonna get the funding, and are we gonna have to go back and ask for additional dollars later, or wait until 2059 when I have extra money? Do you know what I'm saying?
I think the real, true, honest answer is we can do the best we can with some funds that we're not confident enough to even build in our 5-year forecast, and hope they come in and begin to list what is our next level of priority. But the reality is, we just simply cannot get everything we want.
Yeah, I think, and I think this list is ever growing. So
Sure it is.
even if we were able to fulfill all 5 of these 6, if you include Melbridge's parking lot, eventually the field house is going to be on here.
Sure.
The field house is a part of it.
Okay, great, it's already included. But my point is, there's always going to be a short list of other
Always.
projects, and I just don't see the reality of it being included in the
We
120.
can try to pinpoint when we're gonna do them, but how many things from 10 years ago that we tried to pinpoint never got done, so.
I also would say to that point, when you look at where we're at, if we are solely dedicating a tranche of money to the PI from the start and from the initiation of it, where we had planned to do other things, that does kind of start to build up a PI. It slowly keeps us in our deficit. We need to be careful that we're not, over deficit spending. But we still have $1 million payment that is coming out. We're currently taking out of PI. 30% kind of reflect that. It's going to capital expenses. Where that money comes from looks different. So we have some leverage there to build up, to earn, to gain interest. to invest and then to reinvest that money back out into other projects that are there as we start to build. And I think we've done a respectable job at being creative with money, moving money, making our money work for us as much as we can, and then moving forward to the next step. I think nothing in this is going to change with that. That is still the point of all of this, is we are still going to do it all. But having that large cash reserve is really nice, because that earns money for us and that works for us as well. And I think that's the other part, that, you know, having all of it that's there and being prudent with it, as we always are, does help us. And I think also we see, you know, and we can't predict all of this, but we have a veteran staff, and you know, 3 to 5 years.
You stumbled over that. I'd like to know what other words you were
We're
considering.
alive, but surely 3 to 5 years, we're going to see a large turnover in staff, and assuming we can bring in some younger teachers, that saves us in that as well. And there's some savings that are there.
What does is it still 30% cash reserve?
Yeah, on what you can carry?
Yes.
Yes.
So what does collecting all of this income tax do to our property tax collections when we have all this dollars
As
sitting there at the end of the year?
You can pull it out of the general and put it into other.
Well, the
Well-
reality is, we're not gonna, you'll see in the 5-year forecast, you're gonna be disappointed that the 1% doesn't, it's not the panacea
Well,
that.
not for the foreseeable future, but once it starts to collect in full.
Well, even when it collects in full,
Isn't that why you're leaning 80%?
because I'm worried, and plus we're digging out of a $4 million hole.
Okay, and then my last question is, so what happens when it's not enough to fund that building that we decided to fund, that may come in at over what you're thinking, because costs are gonna rise by the time you go to put up phase 2?
We built in a 5% annual contingency for inflation. That is there, and as that phase 2 goes, I think the other part is, and as I said from the beginning, if we can address a lot of the high dollar items early and get that while school is in session to some extent, we can avoid some of that projected inflation. So if we can get a plan that's going to address the HVAC or the structure to that, the roof, the windows, that we know we're going to need to replace. If we can get those as much earlier rather than later and lock in that pricing and get that bonding, get that money from that. That also impacts, and that will keep our cost level down. So it isn't a one, we're going to do A and then we're going to do B. We need to do both at the same time and work through it. But it's really been true how those funds work together, and working with the design professionals and the team to make sure that we're not neglecting one as we do the other.
Well, two of the things that I think are high priority, and I'm basing this off of what Mr. Olesic has said in the past, that he has serious concerns about the roof on Riverside and the leaks. I don't know how that's fair. I haven't had an update, but you might have talked about it in business or building and grounds. The other thing is the bus garage. 3 small stalls, no lift. It's so antiquated. I thought were you talking to Painesville City or something?
We had that conversation with Painesville City about using their garage for significant fixes that required a lift. They're open to some sort of
And they're
partnership
using
with
our
that.
gas pump, so we're partnering.
We're having some conversations. I think a long-term fix for now, that is not right now what we see in the future. I think I would say the safe thing is to make sure that we keep our bus drives where it is to this point. And our mechanics do understand, they work wonders, but it's also to look at alternate options and to watch what's happening with the state and with all the districts. There hasn't been a day when I'm with another superintendent and we're not talking about how can we combine, how can we share, how can we look at services.
Well, that's another thing, so
And
so
so
go to the
school-
capital budget and ask them to help
So
fund a
that's a
joint,
part of it. The
transportation
commissioners had
facility.
talked about
you know,
lake train running.
huh?
And Lake Train running transportation, when we looked at Lake Train to do a single route, it was significantly more expensive than it was for us to do.
They have such a service.
How about a county bus facility?
So we have, so that's Lake Train, and Lake Train talk about,
I-
no, no,
Lake
no.
Train is school, but a school
Maintenance,
bus.
maintenance
Yes.
Yes,
facility for-
so things like that are things that we
Yeah.
have kind of had some of those conversations about, but it's been really as fruitful as Painesville City has a bucket truck. We sometimes run a lift. Now we just call Painesville City and say, hey, we borrow your bucket truck, we'll fill it with gas. So we borrow their bucket truck and we fill what we need to do, and then we can bring it back to them. And so having those kind of conversations are really been beneficial, and this is, you know, we can't go out and blast that out and say, oh, we borrowed a bucket truck on so many days, and, you know, like, those savings are they're limited to some extent, but there are significant. And I think they add up, but they add up. You know.
Now, was it just transportation or was it transportation slash maintenance facility for Chardon?
I believe Chardon just did transportation, but I'll have to
Okay.
double check.
The only reason I ask is that's a fresh price. We, also have that structure behind, the Memorial Junior High in Menor, that looked like it was not difficult to, not super expensive to build, the way they constructed it. And it had a bus wash and everything. I just wondered what the possibility of combining the bus garage and maintenance facility, in the way it would be designed in location.
Interestingly, I just passed that facility this morning.
In Menor or
In
Chardon?
Chardon,
Yeah.
and I think it's combined
Is it?
because the title was not just transportation.
Is it operations?
It was operations as well, and
Yeah.
it was just interesting to me. I was like, oh, I've never seen that.
So, again, something really great that we can look into. I think the idea, though, is that those are other projects not built into the immediate project that is up. So if I hear correctly, I think one of the things we really would need is what's a split, and how does that work? What's it look like in the resolution? So you have that commitment to the public that we are guaranteeing funds for facilities, right? I think modeled out kind of what that looks like over the next few years. We might be doing something like that anyways with the fund, but,
Find out what we can do and then go from there. But we'll have it by Tuesday.
Yes. So we'll have a hold on the agenda for the resolution and probably have the document closer.
Yeah, it might get,
Yeah.
we might get it a little later. Depends on how fast Superman works over here.
Would it be okay or inappropriate for us to have at least visibility to the language of what would be on the ballot in advance of the meeting? Not to discuss it, but to at least,
on the ballot?
What ballot language would look like?
yes.
Yes.
Yeah,
No, it's not
you
in
can
the
share that.
Okay.
Yeah.
We will share
Absolutely.
as soon as we get whatever we have done, we will share it immediately. It just may not be when the agenda goes out initially because Friday is a holiday. We will not necessarily have it for you 40 hours in advance.
We'll have to make a
hold on
motion
the
to add,
agenda.
yeah.
But we'll put a hold
Okay.
for it.
Isn't that part of the resolution, is the ballot language?
No, it's
No.
prescribed in the 572803.
Is that separate, or we don't even have to do that?
We don't write the ballot language.
We don't write the ballot language,
Count does.
we may provide, it won't be in the resolution. We would probably have a draft that we'll provide to you. I'm just gonna copy, Dan and I are gonna copy and paste it from the revised code, and so you can see what it looks like. What you have is you fill in the percentage, the 1%, you fill in your name, the name of the school district, and you fill in is it continuing or for a period of years, and the purpose, its current expenses and permanent improvements. You can't specify anything else beyond that. So it's like going to an ice cream parlor with 4 choices.
That's not fun one.
So it's just chocolate.
Great. That brings us, I think, our only public left, but we will call for it. That brings us to public participation. Anyone wishing to right? No?
Yeah, oh yeah, oh,
Okay.
that's right, the Clippers guy.
Anyone wishing to address the Board of Education will be recognized by the board president. Speakers are requested to speak from the podium. Identify themselves and their topic. Comments are limited to 3 minutes. Do we have any? I just had to put it out there. It was
Because I
on
don't
the
know that
agenda.
anyone else can
I don't
see
think
that
there's-
there's not
No
anyone.
public comment. All right,
No.
thank you. Hey, everybody in this room could be considered public if somebody wanted to speak.
Mike?
That's gonna make awesome, that's gonna make awesome.
You can fill 3
Mike in the
minutes.
back?
I like to speak.
I'll take up 3 minutes, I haven't spoken this whole time.
All right. So that brings us to our next meeting announcements. We have Curriculum and Programming Committee meeting June 17th at
That's tomorrow morning.
7:30 a.m. Finance and Personnel Committee meeting June 18th at 7 a.m. Buildings and Grounds Committee meeting June 23rd at 7:30 a.m. Board of Education work session June 23rd at 5 p.m. And the Board of Education regular meeting June 23rd at 6 p.m.
And all will be held in this room, correct?
Yes.
All right, that makes a motion to adjourn at 8:22 p.m. Thank you, and can you call the roll, please?
Mrs. Krusnensky,
Aye.
Mrs. Grassi,
Aye.
Mr. Audino,
Aye.
Miss Brewster,
Aye.
Mr. Byers.
Aye.
Motion carries 5-0.
Thank you. Hey,
Paul's-
our record's been 10:30 lately, so.
Literally, you guys had a good night.
Yeah.
Good to see you, Fred.
I'll be in touch. Oh, yeah, I'll get you, I'm gonna compile everything.
Yeah, okay, so do you have anything to say? Yes, I was gonna say,
Mike.
Because you want to get a job for more.
I got lots of teachers now.